Everyone dreams of finding that one secret formula for beating the stock market, right? Some kind of hidden recipe buried deep in a company's financial reports that just gives you this incredible edge. Well, today, we're going to look at a strategy that claimed to be exactly that.
Okay, so let's get right into it. And look, we're not talking about some super complex algorithm or illegal inside information here. Nope, we're talking about a pretty famous strategy that, at least on paper, looks like a total slam dunk. And the best part? It uses publicly available data, stuff that anyone, including you, can find. So the big question is, does it actually work when the rubber meets the road?
All right, this whole idea brings us to a really fascinating puzzle in finance. It's called the accruals anomaly. And for years, decades really, it's been this huge thorn in the side of the idea that markets are perfectly efficient. I mean, researchers have been absolutely obsessed with this thing.
So the key thing to get here is that this isn't about some secret code. The whole theory is actually pretty simple. It suggests that investors, as a group, just get fooled. They see the big headline profit number, and they supposedly totally misread what it means for the company's future. And they just keep making that same mistake again and again.
Now, to really understand this, we got to quickly break down just one key accounting term. It's right at the heart of this whole thing. But don't worry, I promise it's way simpler than it sounds.
Okay, so think of it like this. A company's reported profit, it's not always cold, hard cash in the bank. Part of it is what we call accruals, and you can just think of those as financial IOUs. It's money the company has earned on paper, but they haven't actually collected it yet. A perfect example is when a company makes a sale on credit. That's an accrual.
So here's the core idea of the anomaly. It basically splits companies into two different buckets. In one bucket, you have the high accrual firms. These guys have big flashy profits on paper, but their actual cash flow is kind of weak. Then, in the other bucket, you've got the low accrual firms. Their cash flow is super strong, which means their profits are much more, solid. And the whole theory is that investors just fixate on that big profit number and completely ignore this huge difference in quality.
And this quote right here, it gets right to the heart of the mistake investors are supposedly making. They're treating $1 of IOU earnings as if it's the exact same as $1 of actual cash earnings. But you know the saying, cash is king, and it's king for a reason. It's way more reliable, way more persistent. Those accruals, those IOUs, a lot of the time, they tend to just disappear or reverse in the future.
Okay, so if you believe that investors are making this same predictable mistake over and over, how would you actually use that to try and make some money? Well, the strategy itself is surprisingly simple.
It's honestly beautifully simple. Step 1, you buy the stocks of those high-quality, cash-rich companies. You're betting their stock is going to go up. Step 2, you short sell the stocks of the low-quality, high IOU companies, betting their stock is going to go down. See, you're basically just betting that eventually the market is going to wake up and see the difference.
And that is exactly what the researchers in our source material did. Two guys, Nuno Suarez and Andrew Stark, they crunched the numbers on more than 15 years of data from the UK stock market. They wanted to see if this super simple two-step process could actually beat the market consistently. And the results they found? Well, at first glance, they were pretty mind-blowing.
Okay, get this. Before factoring in any real-world costs, we're just talking pure theoretical numbers here. The strategy generated an extra return of about 8.7% per year. Now, in the investing world, an edge like that it's enormous. It really looked like they'd found the golden ticket.
But this is where the story takes a turn. Because you have to ask yourself, if it's really that easy, there's got to be a catch, right? I mean, an 8.7% free lunch every year just by looking at public data, that kind of thing just shouldn't exist in a competitive market. Something's got to give.
And that really is the million-dollar question, isn't it? If all you have to do is sort companies using this one simple metric, why aren't all the hedge funds and big-shot investors doing it and making it disappear? Well, the researchers decided to dig a little deeper to find out.
And they found the answer. It turns out, these incredible returns weren't coming from big, famous companies that are easy to trade. Not at all. The entire effect was concentrated in the market's tiniest, most obscure stocks. The ones that are really illiquid and difficult to buy and sell. These are the companies that are super expensive to trade and even harder to short sell.
And this is the moment where that beautiful, clean theory of beating the market just smashes headfirst into the messy, expensive reality of actually trying to execute the trades.
So, the most important thing to remember here is that the 8.7% return, it was just a paper profit. It only existed in a spreadsheet.
To actually get that money in your pocket, you have to trade. And trading is never free, right? You've got commissions, taxes, and that pesky gap between the buying and selling price, the spread. And all of those costs are way, way higher for these tiny, illiquid stocks.
And folks, this is where the entire story just gets flipped completely on its head. Once the researchers applied some very conservative, real-world estimates for these trading costs, the whole picture changed. That amazing, profitable strategy, it didn't just go down to zero. No, it swung to a staggering 11% loss per year. Just like that, the dream of easy money, poof, it was gone.
Think about that for a second. The very thing that allowed this pricing mistake to even exist, the fact that these are tiny, difficult-to-trade stocks, was the exact same reason why nobody could actually make money from it. It's a perfect financial catch-22.
So, after all that, what's the big lesson here? Why does this deep dive into some obscure accounting anomaly even matter to you if you're interested in the markets?
Well, the study's own conclusion really says it all. Just because you can find a cool pattern in the data, that doesn't mean you can actually turn it into real money. The map is not the territory, and a theoretical profit in a spreadsheet is a totally different beast from actual cash in your bank account.
And that is such a powerful lesson, isn't it? The market might not be perfectly rational 100% of the time, but man, it is incredibly good at getting rid of any free lunch. What looks like a huge, glaring mistake by investors is often just the market being smart in a different way. It's correctly pricing in all the high costs and big risks that come with trading in that specific corner of the market.
And that's the thought I really want to leave you with. It kind of begs the question, right? Are markets perfectly efficient? Or are they just expensive enough to stop anyone from proving they're not? It suggests that maybe the market isn't a perfect genius, but it's just efficient enough. The walls are built just high enough to keep you from grabbing the prize. It's a subtle difference, but a really critical one to think about. Thanks for joining me.